Most financial buyers and a growing number of strategics have a fairly detailed financial model that they'll plug a seller's numbers into in order to come up with a valuation or a valuation range. In a buyer's perfect world, they get the financials from a seller, they run the numbers, and come back with an offer that's immediately accepted. After all, it's a fair offer because the model said so, right? Well, in reality, of course, it's nothing like that. The fact is that sellers don't sell because of what your model says. They sell because of the market that has been created for their company. Even if there's not a structured process to really make a broad, complete market, there's always some form of market that the seller is responding to. And when the market and the model disagree, well, the market's going to win. Now, sometimes this just means you're using the wrong model. For example, bidding based on EBITDA for a business that's focused on growth, or bidding based on net revenue when the market is looking at top line. In some cases, this may just mean that you're the wrong buyer, but if it's a business you actually want to buy, then you may need to look at a different way of valuing the company. A lack of flexibility in these cases is going to lose you the deal. Another variation on this is using a model that's too much of a blunt instrument. We see this all the time with churn analysis, for example. Churn and retention are useful metrics, but there is nuance that can be missed when treated in a cookie-cutter fashion. As just one example, what if the higher churn segment of a customer base actually serves as a profit-making lead gen program for the higher dollar, higher retention portion of the business? If you're able to get more granular in your application of your model, you will win more deals. A third area to consider is synergies. Does your model account for them? Some buyers openly have no interest in synergies between companies, which, well, at least it's an ethos. Most buyers, though, are seeking synergies, but often will use a financial model to avoid paying for them. That's another good way to lose a deal that you would much prefer to win. If you can find a way to help a seller capture some portion of the 1 + 1 = 3 scenario that M&A is designed to create, even if that's through structure, well, you're going to be in a better position. Finally, and this happens more than you might think, sometimes the market is just the status quo. This happens quite a bit in the world of profitable founder-owned software companies, the same ones that I have buyers coming to me about every single day. But when a founder is comfortably pulling out 6 or even 7 digits annually, a lot of the standard financial models don't get valuations to a point where it makes sense for them to sell. Sometimes the buyer's strategy here is to wait the founder out, wait until they're motivated and have to sell, but then you're buying on the wrong side of the incline, and at that point, the metrics may not even support a deal at all. Or, if you're working with a Corum client, they have an even better option than the status quo. Our hiatus process is designed to help CEOs leverage the lessons from an M&A process to drive even more value creation, which could take it out of your range in a completely different direction. Here at Corum, we've seen buyers lose out on deals that they regretted for all of these reasons. Our advice is to listen well and then be flexible and creative in finding ways to bridge the gap between the model and the market.